Good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our webinar today, the third in our installment for the year. So thank you very much for tagging along. Now, I'm of the opinion that I can't be the only one amongst our audience here today looking for direction on several things, not least of all what to make of the recent market gyrations, as well as the accompanying commentary that's come along it. So it's only apt that we've got a nice golden compass there in the backdrop today as we delve into some of these topics. So I'm Cam, the resident financial analyst here at Dunhill, and I'll be moderating and leading today's session. Just a bit of housekeeping rules and a brief rundown of the format for the webinar before we get started. So everyone should be on mute as soon as this presentation begins right about now. However, please feel free to ask any questions in the chat and we'll do our best to answer them for you as we go along. However, please do note we will have a dedicated 30-minute Q&A section towards the end. So you'll have plenty of time to ask any of your hard-hitting questions that you may have stored away. Now, before we start, a few disclaimers to go through just to keep compliance happy. Dunhill Financial is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments may involve risk unless otherwise stated are not guaranteed. Please be sure to first consult with a qualified financial advisor and or tax professional before implementing any strategy discussed herein. Now, with that out of the way, let's move on to our agenda for today. It's been quite the eventful calendar, which would have made it all the more impossible to squeeze every last topic into this 30-minute presentation, as much as I would have loved to do the latter. However, we would like to draw your attention to 4 key takeaways here, namely tapering, inflation, interest rates, and I'm sure what's pretty much the elephant in the room here today, which is China. This will be closely followed by a summary from my colleagues Anya and Isa, who will be discussing some recent tax changes and some compliance items respectively, just to tie it all up. Now that we've gone through all the formalities, let's dive right in alongside Brian. So thank you very much for joining us, Brian, today. I know we've got a lot to unpack here, but before we do that, those skies don't seem like London. So where do you happen to be, my good sir?
Hey, Cam, thanks for the introduction and great to see everybody here today. Welcome to Nice, our first traveling expedition of the year. We're down here for the Adrian Leeds conference. We've got about 75 or 100 Americans that are exploring the opportunities of moving to France, and who could blame them with these skies and a nice beach and mountain backdrop. So welcome to Nice. If you're interested in some of the information, drop me an email and I'll introduce you over to Adrian. And they've taped everything, including our presentation.
Perfect. So with the nice blue skies out of the way with, we've had a lot of talk on tapering, whether it's from policymakers, news anchors. Everyone seems to have an opinion on the matter. However, the man of the hour himself, Jay Powell, seems to be awfully silent. Brian, why don't you give us a bit about what's going on with all this chatter surrounding tapering and what does it even mean?
Perfect. Well, the first thing that we need to do is define why we need tapering and what it is exactly. So let's back up a few years. We had the pandemic. It's not over with, but the financial crisis that could have come about from the pandemic was really alleviated by most major countries, including Europe, the UK, and the United States, all committing to quantitative easing. Now, we're digging into bigger terms there. What is quantitative easing? It's printing money. It's in the format of the Federal Reserve buying up all the bonds from the government so that they don't have to worry about printing that money. But at the end of the day, it's printing money. Now, as you print money in the US, we've been printing about $100 billion every single month. That essentially means that the value of our money that we currently have decreases, i.e. it's an inflationary pressure. And if we're doing that each and every month, eventually we're going to have to get away from doing that and we're going to have to reduce the size of that balance sheet. So the first aspect of it is actually reducing the amount that we're purchasing every month. and that is considered tapering. Now, when it comes to tapering, we gave the analogy in our newsletter at the beginning of the month that it was kind of like going to a party, and every single month or every single hour, somebody was showing up with a bottle of wine or some beers, and all of a sudden the party continues going on. And the question becomes, does the party have to end if you quit installing the alcohol? It doesn't have to necessarily, but it could. And that's to where if we're no longer printing those assets, if we're no longer printing the money, will the party continue thereafter? So that question comes about. And you can only imagine when the last time this happened, or after the financial crisis, the nickname that was given was a taper tantrum. The same aspect would only be expected this time around. So we're watching this very closely. As Cam alluded to, we're listening to every word Jay Powell, the head of the Federal Reserve in the United States, is stating, and it sounds like this is going to come about in end of October or potentially early November. And with that tapering, we'd expect fixed income prices to potentially go up. So it's definitely the driving force. It's definitely where we're looking at the end of the year being the biggest news story, and it will affect portfolios. So we're going to talk about how we're going to hedge through this.
I think given that you've touched upon fixed income and bonds there, Brian, I think it's only natural our next topic is inflation, which ties in quite nicely. So we've extensively discussed during our last presentation, actually earlier in the year, how, however, it seems to have kept a firm grasp in the headlines. So what should we be paying attention to, particularly when it comes to inflation? Are there any particular asset classes we should be avoiding? And just general tips to be mindful of.
That's a brilliant question. At the beginning of the year, we were very, very fearful of inflation, and yet we had Jay Powell and Biden, the Biden administration, telling us that inflation was transitory, that it was temporary, it was going to go ahead and dissipate and disappear. Now we went all the way up to 5.4% inflation in the States, and now it's starting to taper downwards. That being said, we've got a gas shortage globally, and that was where we would expect potentially heating prices to triple this winter, not double, but triple. We've seen coffee prices increase 40-something% year over year. We can name commodity after commodity that's increased significantly. And I think the thing that we realize, Cam and I, we listen to a lot of investor calls with the different CEOs, the different asset managers and such. The majority of them are not talking about whether they're picking the inflation is real or inflation will disappear card. They're going with the card that because the consumer has excess cash from last year's inability to spend, that they'll be able to withstand inflationary pressures. On top of that, that we're finally seeing some wage growth amongst especially the lower income earners. And that wage growth means that they'll be able to withstand some inflation. But inflation has two edges. A little bit of inflation is great. If we get too much inflation, that will force the hand of the Federal Reserve to increase interest rates. And if we have increased interest rates, that should slow down the general economy to the point where essentially it could slow down some of the economic growth amongst the stock market.
I think there's definitely two camps there, the transitory camp and the fact that the other camp, which firmly seems to believe that, we're heading back to the 1970s. So, I think it's prudent to be mindful of both camps, but at the same time, not have any particular biases to one or the other. And, again, be open to interpretation as the facts and figures come in. So we've touched upon.
I'd like to add to that, because you make a wonderful point. We always want to be the coach in this instead of the player. In other words, we have our action plan of what we're going to do if we have high inflation. We have our action plan if we see low inflation. And the point being there that if we do have high inflation, we want to avoid certain sectors of the market, most predominantly being fixed income, because the higher interest rates will hurt us. But we also have other asset classes that we know will do well in an inflationary market. And you've seen some of them edge into the portfolio. And if you listen to our last economic update, you'll notice that we've identified each of those different asset classes.
Perfect. Yeah, no, definitely all good points there to be mindful of. So we've touched on inflation rate. Interest rates now is the next topic at hand. What are your thoughts on this domain, Brian? Do you see interest rates continuing to edge higher? And if they do, what are the likely effects going to be on the markets, and particularly some of the technology names or the technology darlings of 2020? What are your thoughts there?
Interest rates are an interesting place because we've spent since 1982 with decreasing interest rates, and now we have governments that are mostly all-time high deficits, and essentially they're trapped into keeping interest rates low. That doesn't mean they can't increase. It just means that our governments are going to be in a problematic territory. A lot of individuals and a lot of corporations will be in a problematic territory. We've seen some examples of this, for instance, in China this last couple of weeks. So essentially, we would expect our governments and our Federal Reserve or the Bank of England to do everything they can to keep interest rates from increasing, but they don't have that ultimate control. Again, we want to be the coach instead of the players, and we don't want to sit there and pick, are interest rates going up or are they going down? It's, what are we going to do if we start to see them inch up? What are we going to do if we start to see them decline? There's certain instruments that we can utilize to get inflation adjustment if all of a sudden, or hedging of inflation, if it starts to really inch up for the longer period of time. We don't have the evidence of that just yet. So we need to be careful, we need to be vigilant, and we need to be prepared to be able to act quickly if that starts to inch up.
I think just to echo your points there, Brian, earlier on in 2020 in the pandemic, we saw the US 10-year whipsaw quite violently, from an absolute low of 0.4% all the way to the highs of just shy under 1.8%. So again, we've seen the whipsaw in the interest rate environment there. But again, the question becomes how quickly do interest rates continue to tick higher, or if they gradually fade back to the current environment that we're in. And again, as Brian mentioned, there's various tools and instruments that we're exploring on how to best mitigate some of those risks. But again, rising interest rates doesn't inherently mean a worse performing stock market or the technology names, taking a back seat. It just means certain things become more prominent, and we should be asking those questions. Moving along now, actually, let's travel somewhat off canter to the Far East, particularly China. Now, let me just preface this with the acknowledgement here, because I know so many people would appreciate this. But there's been several headlines lately in just about every newspaper and outlet out there under the sun at this point, and it's almost become a staple dietary requirement to receive your daily dose of China headlines, whether good or bad. So what do you think is the bigger picture here, Brian, with what Beijing are trying to achieve with some of these initiatives?
I think the main thing that we need to capture here is the fact that China is either going to be the biggest opportunity or the biggest flop, and probably nothing in between. Great article in the FT this weekend, red flag warning. Is it time to avoid investing in China? Question mark. The key is nobody really knows, because the biggest risk is the political risk. And that's to where in some of our positioning, we have taken more of a position of, instead of directly investing in China, investing in companies that do a lot of business in China. We know essentially that 16% of the world's GDP comes from China, 16%. So it is one of the largest markets out there, but only 4% of the world's market cap comes from China. So we'd expect the market cap to increase. It's whether their government will try to black us out of the opportunity of investing there and continue to try to make regulations harder, or whether this is just a little bit of change in regulation and a few moments that we have to take the opportunity to get in further. And it is going to be the big story of the next year. like I said, it's either going to be the greatest opportunity of our lifetime, or leading back to the same thing that we had in the early 2000s of blacking out some of these firms to where they basically render some investors broke on them. So navigating these waters is going to be important.
Definitely. No, there's a lot of moving pieces here to the China story, and as you mentioned there, Brian, it's either going to be the next best thing or it's on the complete opposite end of the spectrum. However, I'd also like to add that the current environment that we find ourselves in, especially with China, it's not particularly new. Although the extent that what we're seeing some of these crackdowns is somewhat new in flavor, I would say. But if we just go back to 2018, when Beijing was trying to crack down on some of the healthcare companies, and in 2016 it was Tencent, we've seen these regular episodes that the government likes to muscle in and try to show who's really in control. But at the end of the day, we have to understand that China, unlike the US and some other Western countries, they very much think with the long term in mind. Again, that's why you have those 5-year plans. And sometimes that means short-term pain for longer-term prosperity. And I think that's what we're finding ourselves in. But again, it's about navigating the waters here to make sure we safely end up on the other side. And perfect. Well, that actually wraps up the market commentary segment here of our presentation. However, we'll be moving on to our favorite topic, which is taxes, covered by our lead CFP, Anya. So Anya, if you could kindly join us here. But before we do that, I must ask why we have a boat as the cover page, and secondly, what's going on with the recent taxation changes in the US?
Thank you, Cam. Excellent questions, and thanks for the introduction. So some of you might have already met me, as I take care of financial planning at Dunhill. And even though during your 2021 taxes is still quite far off, it's definitely not too soon to begin thinking about strategy and planning for end of the year tax related activities. And so that's what we want to talk about today. And with the topic at hand today, it's important because many of you might have heard that recently House Democrats proposed a 25% federal tax rate on capital gains, so an increase from the current rates, and that's for higher income taxpayers, for married filing jointly, $450K in income per year, or $400K for single taxpayers. There's also another proposal from Biden that calls for a 39.6% tax rate on those who make $1 million or more per year. So certainly large proposed tax hikes on capital gains. In the near future, we'll of course know if these proposals will go through. And before the end of the year, we would like to make 2 recommendations for you. So first, tax loss harvesting. Definitely take a look at those tax loss harvesting opportunities in your account. Some of you may ask, what is tax loss harvesting? Well, that is when you sell your investments at a loss to offset some of the gains you've realized by selling other securities, and so therefore reducing your tax bill. If you have accounts managed by us, we certainly utilize that strategy, and that's what we aim to do before end of the year. So tax loss harvesting, definitely an important topic. And then 2, with all the taxation changes on the horizon, if you do have accounts where you have lots of capital gains, perhaps before the end of the year, before we know how these taxes will change, or once we know how these will change, you might want to consider taking some of the gains in 2021 and rebalancing your account before the year end, as capital gains taxes next year might be higher. Now, I should point out, yeah, go ahead.
So just to interrupt there, Anya, the taxation changes, I think they don't apply to everyone, correct? There's probably a certain segment that this will apply to. So I don't think it's something for everyone to be in alarm or panicked about.
Absolutely, especially we're pointing out that this is mostly for high income earners, but also these changes will not apply to you if you reside in a high tax jurisdiction already where capital gains taxes might be higher than what's being proposed. So those are definitely important things to keep in mind. And of course, probably in the next couple of weeks, couple of months before year end, we'll actually know how these capital gains taxes will look like for 2022. And that's a perfect opportunity, a perfect time to start strategizing and start making some decisions if necessary. And with that, let's talk about another interesting development on the subject of capital gains. And that's the introduction of capital gains taxation on cryptocurrencies. Really, it's means for the US government to pay for part of the infrastructure bill approved by the Senate back in August. And here's how it will work. Essentially, the cryptocurrency provisions clarify that virtual currencies are capital assets, and as such, all transactions, including transfers between brokers as well as sales, are subject to cost basis reporting to the IRS. So net gains are taxable as either short-term or long-term capital gains, depending on how long you've held your crypto. And then also any person receiving more than $10,000 in cryptocurrency will need to file a suspicious activity report known as SAR. And so definitely a lot more regulation coming down the line here on cryptocurrency. And with that, Cam, back over to you.
Perfect. Thank you very much for your insights there, Anya. I'm sure we'll have much more to discuss as we get closer to the tax season. Moving along, we actually have a short piece from Isa, our compliance officer, on some important changes to ESG and MiFID. So here's a quick short message from Isa.
Okay, thank you, Cam. So yeah, we're going to talk a little bit about compliance, and as you all know, this is a very multifaceted topic, and I'm going to dive a little bit into the ESG topic. I think you've all heard of ESG, and you know, by now it's been such a big topic, sustainable investing, impact investing. And first I want to address the three letters that make the acronym ESG. And what are they about? So the E is just standing for environmental. I think this is quite obvious. I mean, we all care about the world and what's going to happen with climate change, etc. The S is for social. This is, for example, as you all know, you know, how are the circumstances for people to work in a certain company? Are they treated in a human way, for example? And governance is addressing something that is also related, for example, to human rights in work environments, but also, for example, human rights on a national level. So are governments treating their people right? And these are all aspects that we do want to consider and also have to consider when investing. Now, since last year, April, there have been some changes in regulation, more specifically MiFID II, the European regulation, started to enforce that every advisor has to talk with their clients about ESG. As you know, probably, we have been addressing this topic before already because it's just important to us, and it's also important to know what our clients, you, think of it. So we started sending out questionnaires to you, and wanted to gauge how your opinions are in relation to ESG. And with this, we are also addressing the regulatory requirement, which is saying that we have to know how you think about these things because it affects your investments. A lot of people are asking the question, so when I'm investing in a sustainable way, do I then lose profit? Do I lose performance in the funds that I'm choosing? It's a fair question, of course, because there are so many different things you can look for in a fund, and sustainability is just one thing. And so I want to give you 2 examples of funds where the non-ESG equivalent has actually not performed as well in the long term as the ESG fund. So let's have a quick look here at KLD compared to SPY, for example. So KLD is essentially the S&P 500, only that it's took away, so the fund manager, the index takes away all the companies that are not meeting the ESG criteria. So for example, oil companies would not be in there, or weapon companies, anything like that is not classified as ESG, or it doesn't meet the ESG criteria. So those are scrubbed out of the index. And when we look at this fund compared to the S&P 500, which is all-inclusive, so it has everything of the 500 biggest companies, then we can see that when we look at this over 5 years, the KLD, the DSI fund, has actually outperformed the SPY, which is just the S&P 500. Looking at the next fund, we want to compare ESG and VEA. And by the way, SPY and VEA have been funds in our portfolio, and we started to actually switch over to DSI and ESGD, as some of you may know. Comparing ESG and VEA, both funds are focusing on international companies. It's developed market funds, and ESGD, just like DSI, is just scrapping all the companies that do not meet the ESG criteria. So looking at those 2 funds, we can also see that, looking at this over 5 years, the ESGD has actually outperformed the VEA. So naturally, we can now say, because there has been this sustainability boom, so to say, a lot of people went towards sustainability, which naturally also helps these funds thrive. The question is this going to stay like that? What if it changes? What if at some point a non-sustainable fund, or a fund that is not specifically focusing on being sustainable, what if that fund starts performing better than another fund that is meeting all the ESG criteria? Naturally, we want to take this into account, because for everyone, some people really want to know that whatever they invest in is making a positive impact in the world, and they don't care as much about the profits. But there are also naturally people that say, it's nice if my fund is having a positive impact, but I still want to have profits. And actually the profit weighs more for me than the sustainability does. This is why we have this questionnaire that you may have seen already, come across, or you already took it already, to see how are our clients actually seeing ESG, seeing sustainable investing, what is important to them, where are their priorities. And knowing this can make it easier for us to personalize your portfolio even more, so that we know in times when, for example, a sustainable fund is not performing as well anymore as a or less sustainable fund does, then we can easily just say, okay, so, this client is not as attached to investing in a specifically sustainable fund. This client doesn't mind just investing in a generic fund, let's say it like that, but is really looking for profit. And then we can easily just change the portfolio based on that, knowing, what is important to you. And yeah, with this, I just want to stress how important it is for us, and also for you, that you take this questionnaire. So if you haven't yet, you can just very easily find it on our website. Otherwise you will get the link automatically with your next review. Thank you so much.
Perfect. Thank you very much for that, Isa. I'm sure we'll have lots of discussion, particularly surrounding ESG and impact investing, especially as the industry begins to pivot as a whole. I'm sure Brian and I are hearing a lot of chatter amongst the fund managers as well. So definitely a topic for later on. Before we open up to our Q&A segment, as well as introductions from some new faces, I just want to quickly introduce our new product, DFS Direct, which is launching early towards the end of this year. It's currently in an alpha stage with a soft launch in France towards the end of the year, with Europe-wide rollout early into next year. Now, the reason we've been doing this is we've been experiencing an increase in inquiries from the emerging affluent class of investors. And instead of turning them away, we want to provide a more automated solution, which gives them access to our model portfolio solutions without the personalization and high touch that Dunhill Financial offers. This new endeavor will also allow us to integrate some of the technologies from the Robo solution to Dunhill Financial itself, therefore freeing up more time to engage with you. And with that, I'll play a very short commercial, and we'll be right back towards our Q&A. All right, ladies and gentlemen, we're just about wrapping up here, but before we open the floor to Q&A, we want to do a quick introduction to some of our new faces in our team that I'm sure some of you have had the pleasure with working alongside. We are continually expanding and recruiting talented individuals to expand our offering and provide the highest client satisfaction possible. With that said, let's actually get them up here on the screen. So Mariana, if you could please come up on screen and introduce yourself and maybe share a little what you do here at Dunhill Financial and maybe some interesting facts about yourself.
Thank you, Cam. Hi, everyone. I'm Mariana. I'm an administrative assistant dealing with onboarding clients and operational duties. I'm also active in accounting as part of my studies, which motivates me actually to work and learn more about the financial sector. In my free time, I'm just going for a run by the river or hanging out with friends. Well, simply, this is me. Thank you for listening.
Perfect. Thank you very much for that, Mariana. Andrew, how about we get yourself up on the screen now?
Hi, everyone. My name is Andrew, and I'm an associate at Dunhill Financial. I am responsible for the client onboarding experience along with general client support. I hold a master's degree in investment management from the Henley Business School. And over the past 5 years, I have lived in 5 different countries as an American abroad. So my experiences with the difficulties of investing in financial planning as a US expat is a major reason why I'm keen on helping other Americans such as yourself abroad with their financial goals.
Perfect. Definitely a virtuous goal there, Andrew. Thank you. And last but not least, we've got Josh. So why don't you tell the audience a little bit about yourself?
Absolutely. So I'm Joshua Madden. I'm a U.S. expat originally from Central California with an international background, including a master's degree in European law and economics, as well as work and study in the UK, Israel, Belgium, and Germany, largely in the fields of business growth and regional investment. I've joined Dunhill Financial in client relations, and I'm working towards my qualifications in both investment advisory and financial planning. Aside from that, I really enjoy travel, which I can't do much of right now at all, actually, due to COVID, and language learning. So I speak English and German. I'm still working on Italian at the moment.
Perfect. Thank you very much, Josh. I'm sure our audience here will have the pleasure of working with all three of the individuals throughout the time. Thank you very much for sticking with us till the end here, ladies and gentlemen. We'll now open up the floor to any questions you may have.
While we're waiting for some of those questions, Cam, wonderful job putting together today's presentation, and wonderful seeing everybody get involved. It's great to see all the variety of different faces. One of the faces that you noticed was recorded in there was Miss Isa, which many of you have been asking the question. She will be back full-time next week. She's going through a full recovery, as you all know, and we're excited to see her back on a daily basis, starting, I think, next Monday. So,
yeah, definitely exciting times. While we wait for the audience here to liven up and send some questions our way, Brian, what are your thoughts on the recent Evergrande matter? I mean, we briefly touched upon China. What's your opinion on what's going on there, and are there any sort of tail risks that we should be paying attention to?
Well, before we define exactly what we think is going to happen there, why don't you give us a little bit of background for anybody that hasn't been following their China daily news?
Absolutely. I think I'm more surprised than anyone who hasn't been had their daily dose of China news yet. But yeah, excellent question there, Brian. Evergrande is actually the second largest property developer in China. Now, the reason why it's so important is because property plays a huge role in the Chinese economy. I can't remember what the figures were last time, Brian. I think it was close to 29%.
29% of the economy is real estate driven.
Yeah. So you can understand why it's reverberated across the markets, both here in the West and in China particularly. Now, the issue comes with some of the debt having lately and the cash flows naturally being very difficult to pay some of the bondholders, which has, well, sort of led to this conundrum here. But that's what's going on with Evergrande, right?
Well, I think there's two sides of it. I think it's how it's going to affect the developed world, and that's a question of what's going to reverberate through to the banks. We've seen the list of banks. I know Cam and I were laughing a little bit that some of the most guilty banks of being part of some of these deals in the past are not on that list, which was great news. But we'd expect some of those losses to reverberate through into those bank earnings, which we'd expect near the end of the year. After a year of great earnings from the banks, which mostly didn't come from banks having a great year, but instead being able to recapitalize through their reserves, i.e. they expected the financial crisis to be much worse on the individual consumer, I think they're going to be able to swallow that very easily. So I'm not so worried from the domestic banks that have invested in them. But from the other side of things, on the Chinese side, it will be, I don't want to call it a Lehman moment. It will be the question of how the government deals with these types of big issues and how much of an example they want to make of them. I don't want to call it the Lehman moment because, as you astutely stated, Kim, 29% of the economy comes from real estate growth, and they're in very much need of that annualized GDP growth, which has already been brought down to that 7% area, and they want that growth to continue. So I tend to think that they're going to find a way to make the mechanism work to be able to deal with the debt in the best of ways. And it's just going to be one of those bigger stories like a Bear Stearns or like a Lehman Brothers that is a speed bump along the way towards prosperity.
Yeah, definitely. We've finally got some questions here. We've got a question from Rhonda. An individual's choice for ESG investing. What will be your approach to following these principles but still optimizing for growth?
I love it. That is a wonderful question, Rhonda, and you know we're passionate about these types of elements. We more want to understand what people are going after, because all of us are consumers just as well as investors. So if all of a sudden we're offended by some of the ways that that we're investing, we're probably living the same life in how we're consuming products. And the amount of awareness that's coming out has only increased year after year, decade after decade. Now, one of the things that we're really working on, first, we're trying to actually get the data of exactly what questions we want to implement. Cam was talking about one of our projects of being able to be more inclusive to the emerging affluent investors and different size of investors, instead of only being able to help financial planning clients. And this DFS Direct product is going to give us access to different technology. One of the ones that hopefully we'll be able to roll out at some point in time next year is going to be aggregating information just more on a visual aspect of how we look at ESG, each of us as individual consumers, and to be able to pull that back into how we can pick those segments without it actually degrading our returns. So for instance, if we really like renewable energy and we specifically like wind farms, how much of our portfolio can be in that, and how much of our portfolio can exclude the Exxons, the Chevrons, the BPs, et cetera, without it actually removing any performance from our overall account. Now, the beautiful thing is what Isa was talking about was that some of these segments, there's actually not that much of a correlation. It's actually decorrelated. So we get the double whammy. Now, most of that was proven when oil prices went from 110 down to negative. Now we're getting the question, as we get back up into $80 range with oil prices, where will be that next step, and will it still be correlated in that way? And that's why we're actually trying to measure all of those aspects and decide how much we can get in there without it affecting our portfolio. But that's just one big element of the portfolio, because one element is excluding and including the technologies and the companies that are the biggest proponents for good change, and removing the companies that are not. But the other side of things is making sure that we own in vehicles that are going to vote and use the proxies for these shares to vote them in a responsible way. The big story over the summer was that a bunch of hedge funds, a bunch of asset managers pushed ExxonMobil to actually include 2 ESG proponent board of directors. Now, that is huge, because that is the long-term direction of the firm. And if we can get the right influence, that can change that long-term direction. So we want to make sure that our shares are being voted the correct way, instead of just saying we're including and excluding the right companies. Multiple facets. We're going to be talking tons about this subject, and I hope that answers your question, Rhonda. I went on for a little bit. My apologies.
No, definitely. I think ESG is such a big topic that, it's a matter of where to start. We've got our next set of questions from Malcolm. Excellent question as always, Malcolm. So Malcolm's question is, nobody knows what will happen with tapering inflation or interest rates, or for that matter, China as well. Is it a case of sell in September and go away? I thought it was sell in May and go away.
No, that is a great way of putting it. I do feel that's a perfect summation of the economic update. Is a big question mark for the end of the year. I'm looking at it more as the analogy when the pilot comes on the flight and says, you're going to be facing some turbulence, everything will be fine. Please hold on for 10, 20 minutes. We know September is historically the worst worst month of the year. We said that in our newsletter at the beginning of September. Because of China, it ended up being true. We're only 4% or so off the highs. Cam will correct me if I'm...
It's about 5, but we'll call it 4.
4 rounding up to 5. So essentially, yes, that came true, but we're not even at a correction. We're only halfway to a correction. Now, we know October and November is going to really be taken over by tapering. If we end up having a push up in interest rates, it's probably going to be safer to be in the general market than it is going to be in bonds or cash. Main reason why is really quite simple. If we go back to the example earlier that a couple weeks ago, coffee prices were up 43% year over year. and we use the example of Starbucks. I'm not trying to say I'm a proponent of their coffee. I'm just trying to say it's an easy example to utilize. If they take coffee prices, they've increased 43% year over year. Now, all of a sudden, for a short period of time, we'd expect their stock price to go down because they're less profitable. But when we hear these CEOs talking, saying the consumer can withstand the price increases, what does that mean? That means they're going to increase their prices to keep their margins the same, meaning inflation should stay correlated with the stock market over due course. It works as long as inflation doesn't go too high. And I don't think we're looking at the 1970s type of inflation. If we have some sort of inflation, it will probably be just not our typical 2 to 3% that we faced the last 20 years. So that takes us through October and November. And as we get into the new year, historically, January becomes one of the better months of the year. I would expect that to be tenfold, because remember what we were talking about at the beginning of this year. It was, hey, the stock market's done great, but it's not the stock market that's done great. It's a certain segment of the stock market, which happens to be the biggest portion. Technology, the FANGs, Facebook, Apple, Amazon, Netflix, and Google make up 23% of the S&P 500. So naturally, when those 5 stocks are doing really well and everything that's in that segment, all of a sudden, the stock market's driven up, but maybe the other 70% isn't doing so well. When Cam sat there earlier in the year and looked at the year over year numbers for even weighting the S&P 500, it was barely up by a couple percent. So now the other side of the economy, the other side of the stock market are starting to rebuild, and they're going to start to catch up. So again, we would expect things to start to normalize, and some of these high multiples, we didn't really cover it too much today, but the stock market is at high multiples. Well, they'll come down as earnings continue to grow on that other side of things. So it's kind of that tale of two cities there.
Exactly, and I think going back to your point there on inflation, Brian, again, with the many countries reopening and factories coming back online, a lot of the inflationary pressures that we're seeing, whether that's in commodities such as lumber, although lumber's pretty much gone back to its usual schedule, or whether that's some of the industrial metals, a lot of these issues that we're seeing now in the various economies is due to the lack of supply, because naturally a lot of these factories and mining operations were shut down because of the pandemic and the subsequent lockdowns. Now naturally demand has gone right back up, sky high, because no one really expected that just after a sort of mini recession, if you call it that. But naturally, no one's planned ahead in advance. So with all these orders flooding through, but not enough time to build these inventories, then naturally, we have more of these inflationary pressures in prices, such as coffee, industrial metals, or for that matter, continuing to inch up. Now, with some of these economies coming back online, we are seeing a gradual decrease in some of these prices as supply does hit the market, whether that's from central banks or central governments such as China, offloading certain key strategic reserves of metal and grain out onto the open market to curb some of the speculation. But again, the inflation debate is very much a fluid situation at this point, and I think we won't be able to fully determine where we are until it's actually run its course.
Absolutely. You left out nickel prices when we're talking about ESG. So naturally, some of these ESG factors are going to increase some of the inflation, and that's where there's again two different tales.
Right, and I think nickel's a bit of a controversial one, because again, we can go on about this all day, Brian. But I think strip mining the earth for certain metals to help with the EV push instead of pumping hydrocarbons is a bit of a step backward. But again, there's as I said, there's various moving pieces in regards to the ESG debate, and I think it'll continue to rage on. I think we're bit lacking on questions here, so unless we've addressed all the topics that everyone had on their mind, please feel free to either unmute yourself and ask any questions directly, or in the chat here as well. Just scrolling through to see if we have any more left.
I think at this point in time, Cam, what we can do is we can wish everybody a wonderful day. We want to thank everybody for coming in and joining this presentation. You've met the entire team now today, and I hope that if you have any questions, you'll feel comfortable emailing myself, any member of the team, with the different aspects of your questions. We might have a little bit of a rocky couple of months, as you know. If we get into some problematic territories, like we did a couple years ago at the beginning of the pandemic, you'll know where it's coming, because you'll start seeing the weekly emails from me instead of the typical monthly emails. That being said, don't get scared. Tomorrow's our newsletter day, so I'll be putting together a nice written form. Cam will get this presentation up on YouTube, so if you have any pieces that you'd like to rewatch, or if you want to share it with any friends, please do. But I hope that you enjoy the last couple of days of summer, as I will, that you're not stuck with any of the gas shortages any place, and that you have a wonderful day.
Perfect. And yeah, as Brian mentioned, ladies and gentlemen, we will be sending out a follow-up email. It will include the recorded webinar for you to review the material in your own time, as well as a more detailed slide deck with some additional information that we weren't able to cover today. But for now, I think we'll be ending the live stream here, and thank you very much for attending.